Welcome to Animal Spirits with Michael and Ben. We are currently recording this in a fishbowl in Scottsdale, Arizona. So we are both here looking at each other. It's very awkward. There's 500 people eating lunch right now at the WellStat conference. Initial thoughts, one day in.
Strong to quite strong, but that's not what we're here to talk about.
Nope. All right. So I wrote a post last week that went uber viral, kind of.
Why don't you drop some numbers?
All right, well, it was a lot. There was a lot of people that read it, but...
No.
We talked about this a little last... There must have been, over 3 days, probably 100,000 people read this one, which is pretty crazy for a post on passive investing.
Yeah, I've never heard of such a thing.
And I didn't think I was saying anything groundbreaking, but this was the Michael Burry thing. He came out with... We talked about this last week a little bit, and he came out with some other comments, and he compared index fund investing to CDOs, which is pretty wild because... to quote you, that's like comparing apples to squirrels.
But wait, I thought there was only one article. Did he have more thoughts?
It was a second article for more questions. And so I went through a piece and I tried to debunk this because I think it's so silly. And I think there are probably, I don't know, how many good arguments do you think there are against the passive investing thing? Like,
what do you mean?
So I debunked the fact that we don't need so many active investors for price discovery. Market liquidity stuff is probably an issue that people shouldn't worry about. And there was someone who sent me a paper, and it was actually Michael Mobison sent me a paper, and see if you like this argument or not. So it was an academic one, and it basically said they've tracked since 1997, and I think the paper's in like 2012, and they said there's a strong correlation between the rise in indexing and ETFs and interstock correlation, meaning more stocks are going up and down together. Is that a fair? And the fact that when stocks do fall, the ones in the index fall together and they fall more.
Yes,
do you buy that?
Maybe a little, but I would question over what period of time do they rise and fall together.
That's the thing. I was also thinking over this period, there's been two huge crashes where guess what? Correlations go to 1 when everything falls. And here's the other thing: we've had a huge rise in indexes since 1987. But we've also had hedge funds go from 2,000 of them or so to 10,000, and they had like 120 billion in 1997 to almost 3 trillion now. We have 8,000 mutual funds. We have 5,000 ETFs. So I think there might be a correlation causation mismatch there. But that was one of the few like academic papers that said indexing is adding systematic risks to the market.
All right. Well, a few things. So Ben Hunt wrote he wrote a post on this topic, and he wasn't bashing index funds, but what he suggests is that what's really out of whack are people's expectations, and they have the expectation that because they have been putting money into index funds and they keep being rewarded, that they feel as if always be buying is the right strategy because that's today's common knowledge. I would ask, is that really based on what? I mean, are there some people who expect the market to do more than it really can? Obviously, but isn't that always the case? And I would say that where there really might be an expectation mismatch is not in index funds, but in active mutual funds where people expect outperformance.
I mean, I think you could make the